Financing Fridays. Hello, welcome to the Froggy Five. I'm your host, Jim Froehlich, founder and managing partner of Froggy Companies. And today I'm privileged to be joined by Jason Yarusi. What are you doing to deal with sort of the financing landscape? And did you get caught with any bridge loans like we did on a project in Colorado? Now, ground up construction is more risky, but
yeah,
we got caught with one of these bridge loans.
What was the result? What did you have to do?
Having to retrade for a very expensive other loan is our situation.
We had two fixed ones, and we had one that was and they were both like $8 and $7 million that were refinancing with banks. We're refinanced with banks, and I've been trying to move things to banks right now. I have a couple of agency loans, but the bank loans, they're not like the best rate, and they're not the best term, but they have flexibility. And so if you believe that the rates are going to settle down and rotate in your favor, then I like the banks, because if I get, like, say I'm at prime right now, it's not great, it's 8.5, but in that front, if it's a 5-year fix, 2 years interest only, and it's got a 1% prepay, then it's going to rotate with prime, right? This loan has no upside exposure, but I'm able to loan mod down if prime goes down. And if the rates really decrease, I can go exit and go into an agency loan or sell without much implication on the back end. So I have a couple agency ones, but like those, you have to be locked in. It's like 4, 5, 6 years. Like I got to be locked in with this loan because I have yield maintenance, right? And so like if rates sink to the floor, and I'm like, oh, let me try and sell this thing right now. It could be hundreds of $1,000s, $1 million of a prepayment penalty to try and exit out of a loan, which of course caps your upside.
Yeah. Well, we're in a little different category with the construction side, but we were like going from 9 to 11%. Like guys were trading us like, okay, yeah, we can get this deal done, where we were at 9 or 10 with a plan to go down to 7 or 8. And now people are telling us 11 or 12, right? We'll give you another bridge loan for 29 million or 32 million, but you got to go up 2 ticks. And that makes a huge difference. There's a couple percentage points when you're talking about that size and you're trying to head to go vertical. I'm wondering what, something you said brought to mind something I wanted to ask you. Oh, related to cap rates. So don't do a lot of value add, but, and like I said, I've only been doing this 5 years full time. I was like listening to podcasts for years and, wringing my hands. I'm like already at the top of my own industry, but like wanting to go over into real estate. Then finally I made a lateral move at age 48. And my mentor is a guy, he's the CEO of Permanis out of Michigan, and really taught me the most on underwriting, more than the books that I had before that. But my general thesis is try to come in 150 to 200 basis points below where I can exit on whatever, right? Go to the sources and uses, see what the total cost is, see what a real NOI is, make sure expenses are good. It's pretty simple. In 10 minutes to back a napkin, where are we at here? I get tons of value add guys, and a lot of them are pretty successful what they do. Now it's changing a little bit, but they say they would be in Dallas, Fort Worth area. They were still buying at pretty low cap rates. So when I see stuff like I got something yesterday, this guy says he can buy this. It was in Arkansas. It was 6.5 cap rate, already approved 7.5% interest loan. And then I go down the line and I just say it doesn't make sense. So in my macro level, I'm looking to buy things at an 8 cap minimum. Like if I can buy it at an 8 cap now, how do you analyze and underwrite deals in context of this financing challenge right now?
You do have to look at the market, right? But on that front, the easiest way is that if you're looking at your existing cap today, you're going to put 10 basis points onto your future cap, right? It doesn't go where you're going to buy, but you can look at the market cap to where the future is. Because if you were doing that for years, cap rates were going in inverse, right? So you were actually, putting yourself in a better position because you were anticipating exiting, right, at a higher cap, and then ultimately exiting at a lower cap. But you're right, where rates are today, with that model, 2 cap rates, it's hard for us to go out there and just picture that, I'm gonna buy at a 5 cap with a 7% loan, and it's gonna make sense. right? Especially right now with where rates. Because if I look here, even at prime, right, you talk about, being an 8% cap. Well, if I look at that model and I say, okay, well, let me look at where prime has been historically, and prime has ranged about 6.25 to 6.5%, right? Mm-hmm. So on historical average, that's been prime. So if I look at that rate, and that's my assumption of where I can be, buying it at 8 cap gives me a spread that my thesis is that rates are going to moderate back to that point, and I can get to that potential to have that. Or if treasuries stay the same, I can go agency and hopefully, we just did 2 agency loans. One's at 5.65%, and one was at 5.89%. So if treasuries stay consistent and the bond market doesn't blow up anymore, right? Mm-hmm. I can be at a loan too that would be in some better position than, of course, where prime would be. So I would set the stage to really look at that perspective. What is my future view on where I want to go?
Okay, great. Then I'm not too far off the mark when I think of these value adds. I'm like, I'm not crazy. I like to talk to somebody that's successful at it. Say, I'm not crazy, am I? Like, guys are still buying things at 6
Well, some of these markets became 6 cap markets when they really are never 6 cap markets. They were 6 cap markets for a moment in time, but they're really an 8 cap market, right?
Exactly.
And that's some of these secondary markets, like the Miamis, the New Yorks, right? Like some of these are just always going to be low cap markets, right? But then if you're, let's say you're in Little Rock, but then now you're like an hour outside of Little Rock, and like it's a 6 cap. Like, well, it's a 6 cap for a reason because there's 30,000 people in town. Like it's not really a 6 cap, it's a 10 cap, but a 6 cap looks good because you've been buying at 4 and 3 caps for years.
Are your units all in secondary and tertiary markets, or do you have some urban, like big city stuff?
Yeah. Too? So like I have Nashville, I have Atlanta.
Okay.
So we're in the suburbs around there, so I'm in Cleveland. So I'm in surrounding markets, right? So they're usually second tier markets.
Okay. Good. Nashville. Are you pretty close to Nashville?
I'm 25 minutes from Nashville. So we have properties there all the way down to here where I'm in Murfreesboro.
Okay, great. Yeah, we've done a lot of projects. When I say me with Promanus, downtown condo deals in Nashville.
Oh, nice.
To the point where at some point John was like, okay, I don't know, are we competing with ourselves here?
Yeah.
Promanus and CA South, but like luxury condos more.
Got it. Yep.
But it's hard to understand something you understand better than me, just like right outside of Nashville. It's a little more tricky when you get to the submarkets just outside of Nashville in terms of how you're viewing comps relative to downtown Nashville.
Yeah, they're not. It's not comps, because you're in each little submarket. Yeah, so you got to be in the submarkets from there.
Different world. Have you had any luck with assumable debt? Sometimes I see these coming in with like assumable debt. Have you done any one of those deals?
Yeah, we did a 32 unit here in town that the rate was 3.93. And the guy had to sell for another project. So we basically brought it at par, it's 75% loan to value on a 3.93% loan. So with 7 years left on it. So it was
7
pretty
years
fantastic.
left. Okay. Yeah. What would you say would be the minimum you would look for in terms of years on an assumable? Like if you saw something that was like 1 year, you'd be like, that's not
no, that doesn't make sense. Cause it just is like, if it was 1 year and the market was coming down, then maybe you could look at it, but really like 3 years is probably the runway.
Okay, great. Well, hey, it's been great talking to you, Jason.
Same here.
Since 4:32, as I know, I don't want to keep you any longer. I appreciate you spending time with me, getting to know you a little bit, because I haven't known you before this interview, and I look forward to connecting with you down the road here, and maybe doing something together. But I appreciate what you've given us today. Yeah. So Jason, tell our listeners and viewers what's the best way to get in touch with you guys and do some business.
Absolutely. So you can find me at Yarusi Holdings, YARUSI Holdings.com, or listen to our podcast. We have the Multifamily Live podcast and the Live 100 podcast.
Excellent. And I will be looking out for those podcasts. And I don't do a lot of multifamily, so I won't be a good guest for that one, but maybe I'll be on one of your podcasts someday as well. I appreciate it, Jason. Thanks a lot and have a good day. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. It was great talking to you, and see you next time.